Have you ever wondered how the stock market works? Picture a bustling marketplace, a hub where buyers and sellers converge. But instead of fruits or vegetables, they're trading shares of companies. That's the stock market for you, a dynamic and complex entity that has been a cornerstone of global finance for centuries. It's a platform where businesses raise capital and investors build wealth. The history of the stock market is a fascinating tale of evolution, marked by major milestones and driven by economic forces. It's seen the rise and fall of empires, survived wars and recessions, and adapted to technological advancements. Now let's talk about what's actually traded on this market. Stocks represent ownership in a company, bonds are basically loans you give to a company or the government, and mutual funds are a collection of stocks, bonds, or other assets managed by professionals. Each of these investment vehicles has its own risks and rewards, and understanding them is crucial. Understanding the basics of the stock market is the first step towards successful investing. In the world of investment, risk and return are two sides of the same coin. This statement sets the stage for our journey into the complex dynamics of the financial market. Imagine risk and return as a seesaw. On one end, you have risk, the possibility that your investment might not pan out as planned. On the other end, you have return, the potential earnings or profit from your investment. The balance between these two is what every investor aims to achieve. In a perfect world, we'd all want high returns with low risk. But alas, high returns usually come with high risk. This is known as the risk-return trade-off. It's like a universal law of investing. The higher the potential return, the greater the risk involved. So how can you navigate this tricky balance? There are several strategies, but let's focus on three key concepts: diversification, asset allocation, and the importance of a balanced portfolio. Diversification is like not putting all your eggs in one basket. It involves spreading your investments across various assets to reduce risk. If one investment tanks, others might do well, offsetting your losses. Next, we have asset allocation. This involves dividing your investment portfolio among different asset classes like stocks, bonds, and cash. The goal is to balance risk by investing in different areas that would each react differently to the same event. Finally, the importance of a balanced portfolio cannot be overstated. A balanced portfolio is a mix of different kinds of investments. It's designed to balance risk and return by diversifying assets and allocating them according to an investor's risk tolerance and investment timeframe. In essence, these strategies aim to manage risk while maximizing returns. They don't eliminate risk entirely. Nothing in investing is ever a sure thing, but they can help mitigate it. Risk and return are integral to investing, and striking a balance between them is crucial. It's like walking a tightrope. You need to balance carefully, understanding that while the potential for reward is great, a fall can also lead to significant losses. But with the right knowledge and strategies, you can navigate this high-stakes balancing act. Investing is not about following the herd. It's about making informed decisions. Armed with this principle, let's delve into the essential steps of due diligence and research that every investor must undertake before diving into the stock market. First, understanding and analyzing financial statements is crucial. These documents, the income statement, balance sheet, and cash flow statement, provide a snapshot of a company's financial health. They reveal information about a company's revenues, expenses, assets, liabilities, and cash flows. By examining these, you can identify trends, measure performance, and make predictions about future growth. Next, evaluating company performance is another key step. This involves looking at metrics like earnings per share, price-to-earnings ratio, return on equity, and dividend yield. These figures can help you assess whether a company is overvalued or undervalued, how well it's using its resources, and how much return you could potentially get on your investment. A deeper dive into a company's operations can also offer valuable insights. What is the company's business model? What are its competitive advantages? Who are its key competitors? These aspects can shape a company's prospects, and as a result, its attractiveness as an investment. Beyond the company level, understanding market trends and economic indicators is equally important. Keep an eye on inflation rates, unemployment data, interest rates, and GDP growth. These indicators can influence the stock market's overall direction and the performance of individual sectors. Observing trends within the stock market itself is also beneficial. Look for patterns in price movements, volume changes, and market sentiment. These trends can provide clues about what might happen next in the market. Finally, remember that due diligence isn't a one-time task. It's an ongoing process, as companies evolve and market conditions change. Regularly updating your research will help you stay informed and make timely investment decisions. Investing without research is like sailing without a compass. Always do your homework. The more informed you are, the better equipped you'll be to navigate the ever-changing landscape of the stock market. Every investor is unique, and so should be their investment strategy. Just as no two individuals are identical, every investor has a unique set of financial goals, risk tolerance, time horizon, and financial situation. These factors are central to crafting a personalized investment strategy. Let's start with the notion of investment goals. Are you saving for a new house, your child's education, or perhaps a comfortable retirement? Your goals will guide your investment choices. For instance, long-term goals may allow you to take on more risk in the pursuit of higher returns, while short-term goals typically call for more conservative, lower-risk investments. Next is risk tolerance. This is your capacity to withstand losses in your investment portfolio. Some people can sleep soundly, knowing their investments may fluctuate dramatically, while others prefer a smoother ride with more predictable, albeit potentially lower, returns. Understanding your risk tolerance is crucial in constructing a portfolio that you're comfortable with. Your time horizon is another key factor. This is the estimated number of years you have to invest before needing to withdraw your money. A longer time horizon generally allows for investing in riskier assets like stocks, which have the potential for higher long-term returns. Conversely, a shorter time horizon might necessitate a focus on less volatile investments like bonds. Finally, your financial situation, including your income, savings, debt, and other financial obligations, will influence how much you can invest and what kind of risks you can afford to take. Armed with a clear understanding of these four factors, you can begin to construct an investment portfolio that aligns with your individual needs. This might involve a mix of stocks, bonds, and other investment vehicles, all carefully chosen to balance risk and reward according to your preferences. Remember, the right investment strategy is the one that aligns with your personal financial goals and risk appetite. It's not about chasing the highest returns or mimicking the strategies of successful investors. Instead, it's about making informed decisions that best serve your unique financial journey. There's no one-size-fits-all approach to managing your investment portfolio. Just as every investor is unique, so too should be the strategy for managing their investments. A variety of portfolio management approaches exist, each with its own merits and drawbacks. Let's take a closer look. First up is value investing. This approach involves hunting for stocks that appear to be undervalued by the market. The idea here is to buy low and sell high. Value investors believe that the market overreacts to good and bad news, resulting in stock price movements that do not correspond to a company's long-term fundamentals. The downside? Identifying undervalued stocks requires a lot of research and a deep understanding of the company. Next, we have growth investing. Growth investors are on the lookout for companies that exhibit signs of above-average growth through revenues, profits, or other key metrics, regardless of the company's share price. The potential for significant returns is high, but so is the risk. These stocks are generally more volatile and can experience rapid price swings. Then there's indexing. This is a passive investment strategy where investors aim to replicate and hold a particular index, like the S&P 500. The idea is to match the market's performance, not beat it. Indexing offers diversification and lower costs, but doesn't offer the potential for outsized returns like the other strategies. Regardless of the approach you choose, it's crucial to regularly review and rebalance your portfolio. This involves adjusting your holdings to maintain your desired level of risk and return. Markets change, and so too might your financial goals and needs. Regular review ensures your portfolio remains aligned with these. In conclusion, each portfolio management approach has its pros and cons, and what works best will depend on your personal investment goals, risk tolerance, and time horizon. Choosing the right portfolio management approach can make a significant difference in your investment journey. Investing in the stock market may seem daunting, but with understanding and careful planning, it can be a rewarding journey. As we've seen, the stock market is a vast and varied landscape, teeming with opportunities and risks alike. The keys to navigating this terrain are a solid grasp of the fundamental concepts, a keen eye for due diligence, and a well-thought-out investment strategy. Understanding the principles of risk and return, the importance of diversification and asset allocation, helps you chart a course through the market's highs and lows. Research is your compass, guiding your decisions with a clear view of a company's performance and the broader economic trends. Your investment strategy is your map, personalized to your goals, risk tolerance, and financial situation. It's about finding the right balance of risk and reward, tailored to your unique journey. And remember, this is not a sprint, but a marathon. Remember, the goal of investing is not just to make money, but to grow it over time. Happy investing!